Recording. Okay. Thank you. We do have a few action items that we would like to present to the committee before we present to the full board. So the first item is regarding the resolution to adopt the 2023 annual budget and plan of operations. On October 27, the last board meeting, we provided and presented a draft to the members. Since that presentation, we made 3 revisions, slightly increased the budget for IT by 150,000, which increases the proposed budget for 2023 to 45.1 million, finalize the amounts for ITA and the Opportunity Fund, and revise the 2023 9% low-income housing tax credit and private activity bond volume cap per capita rates based on the recent IRS revenue procedures announcement. Lastly, we just want to let the committee know that we did not receive any comments from any board members since the October meeting. So I'll be happy to answer any questions regarding the proposed 2023 budget.
Any questions? Hey,
yes, Jerry.
Hey, Hazim, can you, I know we've gone over this again, but can you, on the operating fund and the ITA, just explain that, how that cascades through the resolution and, the thinking about how those two items were sized as far as resources for the authorities program?
Sure. This goes back to the what do you call that? The capital study that we conducted back in 2020, where from that capital study we determined that we wanted to, number one, establish the Opportunity Fund, and number two, to determine any excess revenues that's generated by the resolution and how we should deploy those funds. So from that particular study, what we set forth going forward was to reallocate any previously made ITA repayments back into the ITA, but any interest, excess interest earnings generated from the calendar year along with any excess revenues would then be split 50-50, where 50% of it will go into the ITA and then 50% of it will go into the Opportunity Fund. So the amount that is being reflected in the budget in the amount of 11 million into the Opportunity Fund reflect the 50% of that excess. So the excess in total was about 22 million. So we split that into 50-50 between ITA and the Opportunity Fund. But because ITA has extra, is because we also have about 16.3 million of ITA repayment from the current calendar year.
Right, and since you make both the ITA and the OF available for program, you're really using all of our excess proceeds, not just 50% that goes in the Opportunity Fund.
Yes.
Okay. Thank you.
Commissioner, you had your hand up.
Yes, I did. You say 3 things changed, and the one that I'm curious about is the IT increase of 150. Can you tell us why that was not, what is it going to be used for, and why it was not originally put in the first draft?
Yeah, so that's the reason why number one is called a draft. But essentially, when we were finalizing the budget, one of the things that we realized as we were trying to identify other needs that's tied to the 2023 goals, we determined that we did need additional support, specifically technical expertise from the outside. So the 150,000 is to provide and to procure any third-party assistance from an IT support.
Okay, I don't understand that. What support are we going to get? What is it that we're buying?
No, we're not buying. So what's happening is, as we look at our current infrastructure, we want to make sure that we have either the expertise, or if we do have the expertise, but we do need additional assistance because we only have so many FTEs to support our IT infrastructure. So one of the things that we are looking into going into 2023 is to ensure that our IT infrastructure is where it's supposed to be. So we do need to set aside some budget if we need to procure any programmers that would provide that support if we need it.
So you are buying potentially something that you're buying professional service.
Professional services, but not
Right.
buying like software.
Hardware.
So,
Yeah. Now, this is something I will offer to you. Whenever it is you guys feel ready, we at the Department of Banking, one of the big things we do is IT examinations. And we have some tools, including this thing called security scorecard that gives you a good idea how strong your system is. At some point, if you want, like some of my people to help you or look at it, I can do that for you for free, you know? And I'm not suggesting that I take the place of your profession, your outside entity, because as a regulator, I can never assume the role of an IT for anybody, but I can review people's IT, you know?
Sure. I mean, like we you know, number one, you said the magic word is free. So
Yeah.
we always embrace anything that's free. Number two, anything that would help us enhance our security. You know, we're not going to say no to that.
I mean, and again, I'm not talking about us taking over or giving you any advice about what system to buy or not. What we'll tell you is we found this weakness or whatever, you know?
Right. Now,
you know, there's some computer that's password is not getting updated on a regular basis.
Right. Now, I do want to also note for the committee and also for you, Commissioner, that we do perform those regular tests ourselves on an annual basis because that's required by our audit. So we do run certain penetration tests and utilize outside consultants.
So those Liberty Banks, so those, you named the bank, right?
Yeah. No, I mean,
and so does Bank of America, Chase Bank, except that I don't do them. The LCC
right.
does them, right? Again, it's a suggestion. You don't have to take me up on it.
We welcome any observations.
Trust me, my people are very busy, but
understood.
Yeah.
Hey, Hazim, I don't, the information isn't up on the screen, so I don't recall every aspect, but I recall a line in terms of DOH funding there, and then the other piece that I recall is just the drop in, I think it was not IT support, but it was related to technology. But can you explain the DOH and the interaction there and the funding there?
Yeah, so there's actually a resolution that I'll also be presenting at the board meeting regarding the MOA that we have currently DOH to support them along with the Connecticut Coalition to End Homelessness. So if you remember last year, we asked the board to extend at the request of DOH. So for 2023, they did ask us to extend for one more year, but in addition to the request to extend, they also offered up $300,000 to offset a portion of the cost because the cost is in excess of $300,000. So that's the engagement with DOH and then the funding.
Okay, that's helpful. Thanks. And then again, I think I can't recall, but it seemed like the funding for IT dropped off fairly significantly. Am I wrong on that?
No, well, so it depends to if you're looking at the aggregate. So depending to whether or not you're looking at one of the exhibits that show the amount in aggregate where it reflects the carry over from the prior year versus the new deposit. So when it comes to deposit, it does show a drop because last year when we started instituting the preservation policy and then the prepayment policy, we did receive and approve more prepayments, which those prepayments, if they were funded by IDA, it goes back into the repayment. So then we saw a much bigger amount. And then for the carry forward from this year, one of the things that that transpired this year was we also set aside some dollars to fund the bond debt service for a particular project in Bridgeport to cover for that debt service. So that's the reason why there's a drop.
Okay, thank you.
Azim, I had a question about the funding to purchase a single-family loans. I think you had said you're anticipating purchasing 425 million in single-family loans, and 320 million of that was going to come from recycled prepayments. And I was curious how that compared to this year, and with the increase in interest rates, would you expect the prepayments to go down quite a bit?
Yes. So I think that there's two things going on. So number one is something that would happen year over year, which is we will always have prepayments regardless. It's just the nature of what kind of prepayments are we talking about.
Okay.
Then you have certain circumstances that was happening during that particular year, whether interest rate is low or interest rate is high. So currently we are experiencing, or we are in a high interest rate environment. So we have seen a drop when you compare year over year. Now, in terms of production, so this is where I started off by trying to separate between, what you see on a general basis versus something that is a special event or something that's more cyclical, that we are seeing an increase, and there's definitely more requests for our loan product, just because that while interest rate is high, our rate is much lower. And then also we do have the down payment program that would support it. And then finally, this is where, as we were making changes from 2020, 21, and then going to 22, we also made changes to the lender compensation. So all that, when you combine, we are seeing an increase. So going back to your original question, Kathy, we did put in a placeholder for 425. For this year, when we made our projection last year, we only said that we were going to make 300 million. We are about to close around 370, 375. That's what our number is. So 425 is only an additional 50 million on top of what we did this year. And keep in mind, we still have all the loans that we have reserved and have not closed that came about from the time to own program.
Right.
So that will spill over into 2023 in terms of quote unquote loan purchases and closing.
Yeah. I was just curious. So, anticipating that there wouldn't be people refinancing now that, their CHFA rate probably looks pretty good compared to what they get in the market. Because I know that was an issue with all the people doing the refis. So that'll probably slow down. So I was just wondering if the source of funding from those prepayments, would be affected by people not doing the refis anymore.
Right. So let me just clarify. The prepayments that you identified are prepayments that we are carrying on our books at the moment. So these are not projected or future prepayments. So what happened was the board members in 2020, 2021, we saw a dramatic asset runoff because we're either refinancing, selling the house, whatever it was. And we were seeing a drop on our side in terms of production. So because of those drops, we took a an executive decision to, instead of like calling the bonds, we were trying to harvest those prepayments because we knew that eventually the program will turn around.
Okay,
So right now, we essentially have this ability to redeploy those prepayments into 2023 and then rely less on the volume cap, which we then can deploy for multifamily. But then again, it all depends to the needs going to 2023. So
Yeah.
the idea here is, at least from the financing aspect, we are ready to face whatever we have to deal with.
Okay. Right. And then the only other comment I had, I know it's not probably anything you can deal with, is just that looking at that, the fringe amount as it relates to the salary amount. I mean, it's growing and growing every year. I just don't know how that's sustainable. And it, I'm assuming that's just a statewide issue, but it is pretty amazing.
Yes, it is a statewide issue from a standpoint that we as a quasi, we do participate in the state retirement plan. However, I would say that we did have a discussion with personnel committee in trying to look at ways to mitigate if we can. So we're still in the brainstorming stages, and then once we have something, we'll present it.
Thank you.
Any additional questions? I believe our action item is with regard to the resolution regarding the adoption of the annual budget and plan of operations for 2023. Forgive my newness in standing in. My experience for committee is we're not approving the recommendation, that's for the board. But the motion would be that from the committee to the board would be that the board approve the resolution with the finance committee's recommendation. So given that, I'll entertain a motion.
I move it.
Is there a second?
I'll
A
second.
second. Yep.
Moved and properly second. Is there any discussion? Hearing none, all in favor signify by the sign of aye.
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 Oh, I apologize. I
Yes,
Yes,
understand.
you do.
Get ready. Roll
Jerry
call.
Abraham, sure.
Aye.
Thank you, Jerry. Alexander Dom,
Aye.
Phil DeFranzo,
Aye.
Tim Hodges,
Aye.
Kathy McKinnon,
Aye.
Commissioner Perez,
Yes.
Franklin Perry, Darrell Hill.
Aye.
The vote passes unanimously.
Thank you. Moving on to action item B, the resolution regarding the selection of financial advisors.
Thank you again. So for your approval is a resolution to select financial advisors for CHFA financial programs. As required by our statute and procedures, we are to conduct and publish an RFP once every 3 years for financial advisors. The appointment will be effective for 3 years or for calendar year 2023, 24, and 25. The last evaluation was done in 2019. In summary, we received 5 proposals, and each proposal was evaluated using a set of criteria, including weighing the firm's experience, technical expertise, ideas, reputation, and financial stability. Accordingly, we are recommending 3 firms, Kane Mitter and Associates, CFX, and Mohanty Gargiulio to act as CHFA financial advisors and perform financial functions as determined by CHFA. I'll be happy to answer any questions the committee may have regarding the resolution.
Azim,
Yes, sir.
Jerry again. How long Lamont's term ran for just the 3 years, or were they financial advisor for longer than that?
It was longer than that. So they've been our financial advisors since 1998.
Good. So I just want to just comment. I want to congratulate you on spreading the business around. I think Lamont's done a phenomenally good job. But at least in my short tenure on the board, but I do think it's important that you spread the business around, get different advisors and different perspective. No one should have that seat for too long a period of time.
Thank you.
I say we did put it out to bid at one point, didn't we?
Every 3 years. Yeah.
Right, exactly. So, I mean, we do go through a process.
Yes, yes.
I won't argue that it's the best process in the world, but you know, they went through a process.
We always try our best, Commissioner.
Yeah.
Are there any other questions? Hearing none, as with the previous item, entertain a motion to recommend to the full board approval of the resolution with regard to the selection of financial advisors.
I'll move.
Is there a second?
A second.
It's been moved and properly second. Any discussion? Hearing none, roll call for the vote.
Gary Abrahams,
Aye.
Alexander Dom,
Aye.
Phil DeFranco,
Aye.
Tim Hodges,
Aye.
Catherine McKinnon,
Aye.
Commissioner Perez,
Yes.
Franklin Perry, Darrell Hill.
Yes,
The vote passes unanimously.
thank you. On to reports.
Okay. So before we start the report, I do want to say, at least when it comes to Bob Lamb, just to thank him for his service, being our financial advisor for a very long time. I know that in my communication with Sarah, had she been here, she also would like to acknowledge Bob for his services throughout the years. Okay, so the next item is a report regarding the last bond sale that we did for the final sale for calendar year 2022 for CHFA, the 2022 Series E. And here we have from Citigroup, Mike Kessel and Susan John. So like always, I do have a simple memo to describe what transpired and in comparison to prior deals that we did. But I prefer to let the folks from Citi to take the lead and explain how we went through and dealt with the volatility in the market. So Mike and Susan, take it away.
Thank you very much, Hazim. First of all, can everybody see me? I can't tell which way my camera's turned because I can't see myself on the screen.
Nope.
I can see a wall.
Okay, there we go. Now you should be able to see me.
Yes.
Yes.
Perfect, thank you. Sorry about that. We've only got
It will
5
look
minutes.
better,
What's at the wall look better? I don't know. It sounds
I
like
get it.
Jerry or Hazim, I'm not sure which. But anyway, good morning, number one. Number two, on behalf of Citi, I'd like to thank Connecticut Housing for giving us the opportunity to senior manage its most recent fixed rate single family transaction. We've been doing pricing reports a lot lately, so this should be relatively well rehearsed. We've been in the market a lot. We've been in the market a lot because HFAs have held in there in terms of production, at least in relative terms, and wanting to get into the market quickly because rates have been trending up. The one feature of the market that I don't think I need to elaborate at length is that inflation is the dominant concern. It's talked about on a daily basis on the front page of virtually every newspaper, and interest rates as a consequence have been trending up significantly. HFAs have been wanting to get ahead of that in terms of their financing on their still strong production in spite of higher interest rates. You should have a pricing book in front of you. And if we could turn to that, that would be great. I'm going to do the first half of it. And then I'm joined here by Susan Jun, as Hazim mentioned, and she'll be picking up the more substantive last half, which has to do with the day of pricing and the results of the pricing. So if we flip to, I don't have page numbers on mine, but to the transaction overview. There we go. Thank you very much. Starting with the timing, we went to market The week of October 17th, we anticipated a pre-marketing on the 17th, which is what happened. We released a pre-marketing wire that morning. We anticipated having a retail order period on, or at least we planned for a Tuesday retail order period and then a Wednesday institutional order period. Significantly, in the context of the market that week, we accelerated, and kudos to Hazim, who really pulled the trigger there. On Tuesday at around 1 o'clock, we decided that rather than leave the bonds hanging out there and expose them to further market risk against the backdrop of highly volatile markets, in spite of the fact that we didn't have a full book in place, Hazim said, let's pull the trigger, let's proceed, let's go with institutional pricing Tuesday afternoon. That turned out to be extremely prescient. In the course of the next 2 weeks, the 10-year Treasury sold off by 23 basis points, 13 on Wednesday and 10 on Thursday. That severely affected market tone. I'll tell you a little bit more about that as we move on, but it turned out to be the exact right move to make. So again, kudos to Hazim and frankly, the rest of the team, the syndicate, who were able to move quickly to capture the market Tuesday afternoon. We'll see what Susan will go through the results, and you see the results in spite of that acceleration were quite positive. Moving on down the page, AAA credit, Connecticut's full aware of it, the strength of its credit. We were senior manager on roughly $118 million in non-AMT fixed rate bonds, part of a larger transaction of roughly $150 million to finance a like amount in mortgages going forward. These were also, as has become Connecticut's tradition here now, were social bonds capturing the public purpose nature of the assets that are being funded through the bonds. The financing team has shown it right. I think I've already thanked everybody, but again, kudos to the whole group for being able to maneuver so quickly that week. Flipping the page, quick overview of the bond structure. Very traditional single-family fixed-rate bond structure. Serial bonds out to 34, 3-term bonds. A 15, a 20, and a 25, roughly, year term bond, and then a longer PAC bond to capture the benefits of the yield curve. And that was sold as a premium to generate a little bit of extra income off of it. And so it was a combination of generating a lower yield because it's structured as a shorter average life bond, and also because of its stability, it's structured as a premium bond, and we're able to capture those benefits as well. I'm going to go into a little bit of the market backdrop and then turn it quickly over to Susan. Once again, interest rates up. That's the order of the day. On any given week, we can't predict where interest rates are going to be. 1 week ago today, last Thursday, the 10-year Treasury rallied by 30 basis points. It's picked up significantly. That's coming off of the highs that we saw the end of the week that CHFA priced, where it was at a 424. It's now back around a 475. I haven't looked at it in the last 5 minutes. It could be 5 basis points higher or lower, given how volatile the market is. I'm going to go into a few of the other characteristics of the market when I get to the charts on the next page. I've already mentioned inflation, higher interest rates, the Fed being extremely aggressive. Whenever the market thinks the Fed is wavering in its commitment to reining inflation, the Fed communicates to us that no, we're going to remain just as aggressive. The terminal rate for the overnight rate right now is somewhere north of 5%. Navigating markets can be tricky. The week that Connecticut went into the market was a relatively high supply week against the backdrop of lower supply generally on the year. But it was a pretty heavy supply week from the standpoint of housing. If you look down at the bottom, second to bottom bullet, almost $8 billion in housing bonds that week. Flipping to the next few pages, these just really capture the nature of the marketplace. There's just a few numbers on this page that I'd like to call attention to. If we look in the middle there, I'd like to call attention to the 10-year Treasury. That's the barometer that we use to talk about the market and housing. That's what we use to measure where mortgage rates are, by and large. When CHFA went to market in early 21, it was at a 118. At the beginning of this year, it was 163. It was off from that, but not significantly. Since then, it's moved up 401 at the time of pricing in October. By the end of that week, I've already mentioned, it was at a 425. So it's been highly volatile. And of course, it's pulled back since then. 30-year MMD, that's the barometer we like to use on a 30-year fixed rate housing issue. That's also obviously up significantly, more than the treasuries are, as evidenced at the bottom by the ratios. The ratios indicate our relative value, the relative value of tax exemption to the taxable/treasury market. Turning to the next page quickly, we've got 4 charts here. The top 2 basically show the outflows from municipal funds. Institutional investors tend to run away when rates go up. And we've seen the most significant outflow from funds since the so-called taper tantrum of 2013. It's over $100 billion in outflows from funds, which is a response to higher rates and is driving rates higher at the same time. Against that backdrop, though, the retail investor loves higher rates. They're a buy and hold investor. If they can get a 3.5%, 4+% interest rate that's tax-free, they rush into the market. So we've seen significant activity there. They played a major role in helping us get transactions done, and that was true in Connecticut's case as well. With that, if anybody wants to ask any questions, feel free, if you want to wait till the end. And if not, I'll turn it over to Susan Jen.
I have a question.
Yes.
Got my hand up. I mean, this is really more for Haseem, so maybe I could wait. But my question is, at this instrument, can we refinance it down in the future?
Say that again, Jorge.
Can we refinance this particular?
Your mortgage product or your bonds or both?
I'm sorry?
I think the answer is yeah. I'm sorry. Haseem, I think answered yes, right? Haseem?
Yeah.
Yeah.
The answer is yes, Commissioner.
Yeah, because I mean, I realized the market is volatile. In fact, there was one day in the last week or so that the mortgage rate actually hit over 7%. Then the next day it went down almost 0.75% because the inflation numbers came out and they were much better than expected. So there's a group of us who thinks that if that trend continues, the numbers are going to obviously improve. But I mean, nobody knows, like you stated. I mean, nobody has a magic ball.
Right. The only thing I would say that I've kind of left out of this conversation is that the yield curve is currently inverted, and that tends to portend a future recession. So the current view of the marketplace is that the Fed is going to remain very aggressive until it doesn't. It's going to try to rein in inflation. It's going to do what it has to do to rein in inflation, even if that drives a recession, as evidenced by the inverted yield curve. But at some point in the next year, we're projecting roughly a year from now, that's the 3rd or 4th quarter of next year, it's likely that the economy is going to turn down and the Fed is going to be in a more accommodative state of mind. It's going to start to lower interest rates. And in fact, a large part of the dynamics in the mortgage market are driven by the fact that interest rates are very high now, but we expect them to be much, much lower 2 years from now.
Again, I was not interested in getting the economics lesson because again, nobody has a crystal ball, but regardless, having the option to be able to refinance, that's the key.
Absolutely.
And the question was answered. Thank you.
And both the mortgages and the bonds are eligible for refinancing.
Okay.
I had a question about the institutional versus retail buyers. Why is it with the increasing rates, it is more attractive to retail than the investors?
There are probably a number of reasons, Catherine, but a leading one is one that I alluded to, which is that retail investors tend to be buy and hold investors. They don't care about market fluctuations as much. They're in there. So if interest rates continue to trend up and they see the price of their investment decline with ever higher interest rates, they're not perturbed by that. They've locked in their 4% tax-free income, which if you live in a state like New York and Connecticut translates into something quite significantly higher, 7.5% or more in terms of real return when compared to a taxable investment. Institutional investors tend to be more sensitive to those price fluctuations. And when they see prices trending up, they're more focused on the fact that at some point, the price of what they paid, the investment that they paid 100% today for may tomorrow be worth maybe only 85% of its of the face value. So they tend to look at that more. There may be other factors that at work as well, but that's a significant one.
Thanks.
Present.
Okay, great. Thank you. I will spend a few minutes on page 9, which provides the transaction pricing and financing results. So what's interesting with this financing is that we were coming on the heels of the authority's 2022 Series D multifamily financing that priced just the week prior. I know that Hazim, one of the questions that you had going into our pricing was because you had such great retail demand on your Series D, what would it mean just a few days later coming with the Series E transaction? And we found that we still had very good interest from retail investors here as well. So on Monday, October 17th, we went out with a pre-marketing scale to get the investors focused, both institutions and retail investors. And because the prior week was a shortened holiday week, there was more supply coming into the week that we came into the market. And so definitely coming out earlier that week ended up being the right strategy here. So after the full day of retail on Monday, on Tuesday, we were seeing some good market tone in the morning. So we were hopeful. We went out with a retail only order period. And by midday, we had about 55 million in total retail orders, which is a really great showing. And at that point in time is when we had the discussion about whether to stay with our original plan of having a full day of retail and finishing up with institutional pricing the next morning, or should we accelerate? And I think many of the factors Mike mentioned, which is that, we were looking at heavier supply later in the week. We had very good retail orders on hand already. And the only small missing piece was that the reads from the institutional investors were a little thin at that point in time. But I think Hazim had the conviction that he wanted to minimize that overnight interest rate risk. And so we decided to accelerate that day. So we concluded the pricing Tuesday afternoon, and it was certainly the right strategy. Overall, we received 100 million in institutional orders from 16 different institutional investors, and retail was upsized even further, about 74 million. And in the end, as far as allocation, we had very good wide distribution of bonds. So 37 million of bonds allocated to in-state Connecticut retail investors, 15 million to national retail, and 71 million to institutions. So at the end of the day, the financing results, the authority was definitely nimble in getting in and out of the market quickly to mitigate that overnight interest rate risk. The authority avoided the further competition from other housing issuers that were pricing later in the week. And as we saw, interest rates kept increasing later on in the week. And obviously we were able to assist the authority navigate through a very volatile market and a heavier market. And one thing that we forgot to mention also, earlier that week, the state of Connecticut came in with a $1.1 billion issuance. And so we had a little competition there as well. Overall, the authority was able to achieve an overall bond yield of 4.32%. And this is helped by the fact that we had the variable rate bonds, which is partially hedged with a SIFMA swap. And because of the low bond yield and the higher mortgage rates where the authority is lending, the authority will be expected to create some 0% participations, which is a great tool for times in the future when you might need to have that additional help if you're not able to achieve full spread on a financing. So with that, I'm happy to take any further questions. The rest of this book includes the pricing wires, housing comparables, other housing issuers that were in the market around the same time, so you can compare with the authorities' rates. And we also have the rating agency reports in the back.
Hi, it's Phil DeFranco. I have a question. So when you said your bond yield of 4.318, is there a price difference between, I guess, you know, I'm a Ginnie Mae issuer, so I'm following like a different path looking at that. And when you say are you paid less for the bond in a rising interest rate environment? Were you paid 99 for that, or like, you know, I guess that's my question. Or do you just get bids on a bond at whatever the aggregate yield is?
So on Connecticut's transaction, most of the bonds are priced at par.
Okay.
So our underwriter will go out with coupons that they believe are on market, priced at par. Now, on the back end of the term structure, we have a PAC bond, and that PAC bond is actually priced at a premium. So it's got a higher coupon, but the yield is lower. So that's the only bond that is not priced at par.
Okay.
But overall, when we compute the overall yield on this transaction, including the assumptions that we have made on the variable rate component with the swap, that overall average yield ends up being around a 432.
And then my next question is, if everything's priced at par and you're sending it out on a yield, like at why the benefit? What's the benefit of the hedge? Like, what's the purpose?
Yes. So the swap is helping to hedge the variable rate bonds. The variable rate bonds are put at the back end of the term structure. If the variable rate bonds instead were sold at a fixed rate as a fixed rate bond instead of variable plus the swap, then that bond could have been priced at 5% or maybe even higher. Okay. But because the authority decided to go with the variable rate structure with the hedge, and the swap itself has a 385 fixed rate. So you can see that differential between a 5% coupon on a fixed rate bond versus a 385 with the swap.
Yeah. Okay. And my last question is this always the best execution? Do people look, I mean, 50% of all of the business that CHFA does appears to be in the government section, you know, FHA and VA, USDA. And, you know, like sometimes when I look at the pricing on a government or a Ginnie bond, is it always the best execution to do it this way? Like, is there options? Because I know other housing agencies are approved Ginnie Mae lenders or Ginnie Mae issuers. Is it always the best execution to do it this way?
Phil, I'll address that. It's not always the best execution. It's certainly the best execution in the current market. Right now, the benefit of tax exempt bonds versus just selling the MBS is huge.
Yeah.
We're seeing huge, you're probably seeing this in your MBS world. We're seeing huge compression on higher rate.
100%.
Going back to something I said earlier, we expect these higher rate loans to have a very short duration. Nobody wants to pay a very big premium for a short duration. And there's a real liquidity issue in the MBS market because of the compression on the long end and the steep falling off of prices on the much lower rate. We expect 3%, 3.5% pass through MBSs to pay off very slowly. So that's creating a huge liquidity crunch in that market. And right now, tax exempt bond financing beats the sale of MBS. I think
I'm just saying, like in future idea, could it be a strategic play for CHFA to get their Ginnie Mae approval, so then they could best X the market at any given time? I don't know. I'm just throwing it out there. I don't want to make.
I think
You're
Phil,
welcome for that idea. You're welcome for that.
let's
Anyway,
say that, for CHFA, we have considered either, doing it ourselves or utilizing a third party, right? But any execution, as you know, whether you try to do it in-house or using a third party, it comes with its own advantages and shortcomings.
oh no,
So
yeah,
the way that we are trying to manage it is as we go and start beefing up our program and then making those changes. And then again, these changes came about either from the capital study or something that we've always had known, but we just didn't have either, the funding or the timing, there's just so many things going on. So yes, we are familiar with that concept. We know that other HFAs have embraced that.
yeah.
But at the same time, in terms of what we want to do what's good for the state. So in terms of the execution, we're not shying away from it, but
Yeah.
we're trying to maximize what we have right now.
And I'll agree with Michael 100%. The liquidity and the higher yields, this would definitely be a better execution right now. What I'm saying is, going forward, I think maybe strategically we should look at it, a year from now when the market settles down and when it's more normal, and look at it and see, because I personally believe, knowing all I know about being an active Ginnie issuer, that the CHFA agency could make more money at times looking at a best execution between this bond program and doing something in a Ginnie execution. That's all I'm saying. I 100% agree with Citi right now. There's liquidity issues in the higher yield spreads, and this is a better execution. I just am curious. Maybe it's something to look at down the road a year from now and say, hey, if we were to sell this bulk of them Ginnie and we were able to do these, like, what does that mean? And I can tell you that means more money to the agency. So that's all I mean, in certain times, not now, but certain times.
Right.
So anyway, I'm done.
Good questions, Phil. Thank you very much. Thanks a lot.
Yeah.
Very good question. And just one parting thing that I will say here is that when the authority is bond financing their single family production, depending on the prepayment speeds of these underlying loans, they are earning that spread between their borrowing rate and that mortgage rate. And so that income that they earn over time is accruing to the authority's bottom line that you can use for your program purposes and for any new program purposes in the future. And so it is certainly a very interesting calculation between looking at that overall income over time versus obtaining upfront income versus of selling MBSs.
Sure, got it.
Okay.
Thank you very much.
Okay, with that, we'll move to the next report. Allison.
Good morning. Before you are the October financial reports. On the revenue side, mortgage loan and investment interest revenue is coming in 5.7 million over budget through the end of October and 2.5 million higher than last year. The current year variance is due in part to the increase in interest rates on the authority's short-term investments. Just to give you an indication, the state's stiff rate as of the end of October was 3.16%. And for comparison purposes, the same time last year, it was less than 1%. It was actually 80 basis points. On the expense side, bond interest expense is below budget by 6.7 million through October 31st and 2.1 million lower than prior year. In addition to the amortization acceleration due to the redemptions, the variance is also a result of the outstanding bonds being 622 million lower than the same time last year. Administrative expenses are coming in 6.9 million under budget and 192,000 higher than last year. And when you exclude the salaries and benefits of 22.2 million, the current year expenses are $525,000 lower than last year. And lastly, the change in net position is above target by $22.4 million. Are there any questions?
John, next one.
Good morning. So for the month of October, the authority purchased 148 loans totaling $33.7 million, of which 130 loans totaling $29.1 million were securitized, or 88% of our production. The remaining 18 loans totaling $4.6 million were whole loan. The average loan size was $228,000. For the at the end of the month of October, the mortgage-backed security portfolio balance was $2.1 billion, which was an increase of $10.7 million over the prior month. The whole loan portfolio, though, through September declined by 65 loans, or $7.1 million, with a total portfolio balance of $1.1 million. The overall single-family delinquency rate increased by 1 basis point to 2.39%, and the carrying balance for loans in foreclosure year over year decreased by $8.6 million to $22.4 million, while the number of loans in foreclosure year over year declined by 56. For the month of October, the authority also funded 122 down payment assistance loans totaling $1.9 million, with an average loan size of $15,200. 82% of the October borrowers took advantage of the down payment assistance program. And the authority also funded 131 time to own forgivable loans totaling $4.1 million, with an average loan size of just under $31,000. On the multifamily side, there were 5 new loan closings in October, increasing the portfolio size to 564 loans, with a total portfolio balance of $1.3 billion. There were 7 permanent loan delinquencies in the multifamily portfolio, 1 less than the prior month. There were no construction loan delinquencies. The overall delinquency rate was little under 0.6%. Any questions?
I had a question about the multifamily delinquencies. It feels like the same projects are on the list for months and months. What happens there? Is there any change, or how does that work?
Yeah, there are active negotiations in almost all of them. Most of them, the problems are fairly significant without easy solutions. And so they do seem to take quite a while to resolve.
Thanks.
Hey, if there are no further questions, the last item is the minutes.
Hopefully everybody's had an opportunity to review the draft minutes from the October 27th, 2022 meeting. Anyone have any suggested edits? Hearing none, is there a motion to approve the minutes for October 27th?
I'll move.
Is there a second?
So
I'll second. Any discussion? Hearing none, roll call.
Jerry Abrahams,
Abstain.
Alexander Dahl,
Approve.
I'm sorry, would you say that one more time, please?
Oh, I'm sorry, I said approve.
Thank you very much. Phil DeFranza,
Approve.
Tim Hodges,
Abstain.
Kathy McKinnon,
aye.
Commissioner Perez,
Commissioner, you're muted.
I'm sorry, I'm working from home and the maintenance people are blowing and blower outside my window. So if it's for the vote, yes.
thank you.
And sorry for the background.
Franklin Perry, Daryl Hill.
Aye.
The vote passes with 2 abstentions.
Is there any other business or discussion for the committee? Hearing none, we'll entertain a motion to adjourn.
Moved.
So moved.
Second,
First and a second. Did we do a roll call for adjournment? All right, we are adjourned. Thank you, everyone.
Thank you.
Thank you.
Bye.